Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Palantir Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We're looking at their recent quarter, Q3 2025, and the results. Well, they're not just strong. We're kind of redefining what's possible for a company at this scale.
Right, this is that new reality we've been hearing about. Hypergrowth, but with really high margins.
Exactly.
That's the core conflict, isn't it? We see so many high-growth companies just burning cash to achieve that speed. So what were the numbers that, signaled they've broken that old pattern?
Let's start with the top line. Total revenue for Q3 hit $1.181 billion.
Okay, $1 billion plus.
A substantial number on its own, but the real story is the growth rate, 63% year over year. That puts them squarely in the hypergrowth category.
63% growth at that scale is impressive, but you mentioned profit. I mean, if a company's really focused on efficiency, we've got to look at the margins. How do they do there?
This is where they moved into a truly elite class. They reported JAC net income of $476 million,
Wow.
which translates to a remarkable 40% margin. And operationally, the adjusted operating margin was 51%. Now, this is where we need to talk about the rule of 40.
The rule of 40. It gets thrown around a lot in the software world. For anyone who's not familiar, what does a company need to do to pass that threshold, and why is it so important here?
It's actually pretty simple. You just add your revenue growth percentage to your profit margin percentage. If that number is 40 or higher, the business is considered healthy, balancing growth and stability.
Okay, so growth plus margin.
In their case, you take 63% growth plus 51% adjusted margin, and you get a score of 114%.
114. So they're not just passing, they're curing their exam.
Yeah.
That points to some incredible leverage in their business model.
It really does. It means they are generating far more profit from each new dollar of revenue than almost anyone else. It shows this tremendous efficiency and proves their software can handle massive expansion without cost, just, ballooning out of control.
And management's talking about this, I assume.
Oh, yeah. They specifically said they are focused on disciplined growth. They're making very intentional choices about where to invest and actively refusing to expand recklessly.
That's reassuring. So when we look at where this growth is coming from, one area is it's on fire. It's acting as the engine for all this acceleration.
It absolutely is.
We have to talk about the U.S. commercial engine because that seems to be the main catalyst here.
100%. Overall, U.S. revenue grew 77% year over year, which is very strong. But if you zero in on the U.S. commercial segment, that's them selling to private companies, not the government, that growth rate it's explosive.
How explosive are we talking? Give me the number.
U.S. commercial revenue grew 121% year over year.
Whoa, 121.
Think about that. They've more than doubled their revenue from U.S. businesses in just 12 months. And it's still accelerating, up 29% just from the last quarter. This is the fastest expansion they've ever had in their commercial business.
That kind of growth is just incredible,
Yeah.
especially for a company this size. And the catalyst is obviously their artificial intelligence platform, their AIP. But the market's full of AI tools.
Why is AIP succeeding where others might be struggling?
Well, the big challenge for large corporations isn't just getting an AI model. It's getting that model to actually work inside their messy, complicated existing systems.
Right, the integration.
Exactly. AIP is designed to cut that deployment time from months or even years down to weeks. It lets them go from a small pilot right into a full mission-critical operational program super quickly.
So it's not some fancy dashboard. It's actually getting into the machinery of the business and making real decisions. Is there tangible proof of that ROI?
There is. They give a great example. One of their major industrial customers is running 175 different AI use cases on the platform.
170. And in the first half of 2025 alone, that one customer saved over $30 million.
$30 million. Now, that is a hard number that gets a CEO's attention. That makes the platform feel essential, not just optional.
It's the ultimate sales pitch.
So with this insane performance, that 121% commercial growth, what are they projecting for the future? Did they raise their guidance?
They did. Management raised the full year 2025 revenue guidance to about $4.4 billion. But even though the U.S. commercial side is growing at 121%, this implies a more moderate 53% year-over-year growth for the total business.
Wait, hold on a second. I need to pause you there. If the U.S. commercial engine, which everyone agrees is the future, is growing at 121%, Why is the total guidance only 53%? What is that telling us?
That's a really critical question. It suggests two things. First, a huge chunk of their business is still the government segment, which grows much, much slower, even if it's stable.
Okay, that makes sense.
And second, it suggests management is being, well, cautious, maybe even conservative about their international business. They're basically signaling that while U.S. commercial is running hot, they are not predicting that same fire will catch everywhere else, at least not yet.
So it's disciplined guidance to match their disciplined growth. But they still think the U.S. engine is going to keep firing.
Oh, absolutely. For Q4, they guided for 61% YoY growth, and they specifically said they expect U.S. commercial revenue to sustain that phenomenal 121% rate. They believe this hypergrowth can continue.
Sustaining triple-digit growth.
Yeah.
That implies they're closing deals left and right. Let's talk about customer adoption. Are they just signing up lots of small clients, or are they getting deeper into the big corporations?
It's both, but the deepening part is what's really impressive. They closed 204 deals worth over $1 million, and 53 of those were worth more than $10 million. Customer count is up 45% to over 900.
Those are good top-level numbers. But the real insight is what existing customers are spending, right? Are they getting properly entrenched in these companies?
They are deep into that classic land and expand model. They get in the door with one project, prove their value, and then they just start weaving their platform into everything. The trailing 12-month revenue from their top 20 customers, it increased 30% year over year.
And in dollar terms, what does that look like?
It averages out to $75 million per customer for those top 20.
75 million, yeah.
When a company is spending $75 million a year with you, your platform isn't just a piece of software anymore. It's part of the corporate DNA. The switching costs become massive.
Okay, we have established the bull case. Flawless execution, amazing efficiency, commercial adoption is accelerating. The fundamentals have arguably never been better. Now, we had to tackle the elephant in the room, the stock price.
Mm-hmm.
It's been on an incredible run this year, up over, 112% to 130%. So what does a bear case look like when you're paying that kind of price?
This is where the conversation completely shifts.
Yeah.
It stops being about how well the business is performing and starts being entirely about market expectation. The valuation is extreme.
How extreme? Put it in context for us.
Okay, so if you look at the big tech giants, Microsoft, Alphabet, companies also pouring billions into AI, Palantir, is trading at a price-to-sales ratio that is many, many times higher.
Okay.
But the really telling number is the forward price-to-earnings ratio, the PE.
That's usually the starkest measure.
It's staggering. The forward PE is over 240.
240. So that means you're paying $240 for every $1 of expected future earnings.
Exactly. The valuation is pricing in not just perfect execution next quarter, but years, maybe even a decade, of this kind of hyper growth continuing without a single misstep.
The margin for error is basically zero. If that U.S. commercial growth slows down even a little bit next quarter, the stock could face what they call multiple compression.
A very painful multiple compression. And, adding to that anxiety is the optics around insider activity.
Right. What are the insiders doing?
Well, in the last 6 months, insiders have made 349 reported sales and zero purchases.
Zero buys.
Zero buys. Now, to be fair, a lot of these sales are automated to cover taxes on stock units, but still, the sheer volume creates a negative perception. It just looks like a continuous stream of selling from inside the company.
And that's tied to the other big concern for investors, which is stock-based compensation, or SBC. It's a huge financial drag.
It's a major overhang. SBC is basically paying employees with new shares instead of cash. And while it looks good for cash flow, it dilutes the value for every existing shareholder. You're just cutting the pie into smaller and smaller slices.
And how big is that overhang right now?
It's substantial. Year to date, SBC was $488 million. So despite those strong JAP profits we talked about, this constant dilution is a real friction point for investors.
Okay, so we had the bear case, astronomical price, ongoing dilution, and some concentration risk, right? They're still heavily tied to the government.
They are. The business is still tilted toward its roots. About 55% of Q3 revenue came from government contracts, and 75% of their total revenue is from the U.S. So any shift in defense spending or U.S. policy could hit their top line pretty hard.
So let's pivot back. Is there anything that justifies this extreme valuation? What is the core competitive advantage, the moat, that protects them from, say, Microsoft just coming in and offering the same thing?
The moat isn't just about having good AI models. It's in their deeply embedded technology that they call the ontology. That's the real differentiator.
Ontology. That sounds very academic. Break that down for us.
Think of it like a digital map of a client's entire real-world operations. It connects their supply chains, their inventory, their machinery, all of it. So when you apply AI to this map, the AI isn't just looking at data, it's making real actionable decisions in a mission-critical environment.
So it's not just a chat interface. It's like a full-stack nervous system for the whole company.
That's a great way to put it. It's a full-stack AI layer with security and governance baked right in. And that's where their history comes into play.
From defense and intelligence.
Exactly. Their long history working on these highly sensitive, complex missions gives them a unique reputation. They can go to a big bank or a hospital and market their platform as battle-tested AI. That's a very, very powerful selling point.
Okay, so that's the moat. What about their financial safety net? How strong is the balance sheet?
It's a fortress. They have a net cash position and absolutely zero debt. As of the last report, they had $6 billion in cash and equivalents.
It's going.
That gives them immense stability and options. And they're converting revenue to cash incredibly well. Adjusted free cash flow for Q3 was $540 million, and they're projecting up to $2.1 billion for the full year.
With all that strength, is there any financial metric that warrants a bit of caution?
There is one thing to keep an eye on. Despite the strong cash position, their accounts receivable, that's money owed to them by customers, has risen 75% to over $1 billion.
And why is that a metric to watch?
Well, it could mean that customers are taking longer to pay their bills, which can strain working capital. It's just something you need to monitor to make sure they're collecting on all that massive revenue in a timely way.
That's a really important nuance. So if we pull this all together, we have a company that is performing at the absolute top of its game.
The underlying business strength, driven by that 121% U.S. commercial growth and that unique battle-tested moat, it has never been better.
But the core investment debate has totally shifted. It's not about the strength of their growth anymore. That is undeniable. The question for you is simply about growth. At what price? The market has already priced in years of this perfection. You have to decide if their competitive moat really justifies a valuation that leaves almost no room for error.
It really requires a deep conviction that their tech will stay ahead of the competition.
It does. And that margin for error is the difference between a great long-term investment and a really painful ride down. We hope our analysis today helped you frame that crucial calculation. If you found this discussion useful, please remember to subscribe to Smart Wealth with Joshua to continue receiving your daily market analysis.